In our latest CNBC quarterly stock report, our survey shows that many more respondents believe that the first 4 years of a Biden administration will be worse for stocks than President Trump's 4 years. For more on the markets, let's bring in Steve Whiting, Global Chief Investment Strategist at Citi Private Bank, and Greg Branch, Managing Partner at Veritas Financial Group. Good morning to you both. Steve, results like this in the survey probably reflect this idea or a sense out there among investors that the markets have come a long way toward perhaps building in some kind of recovery. Valuations maybe look a little bit stretched. At the same time, we have all these kind of early cycle recovery forces in play. Where does that leave you in terms of looking for some kind of unexplored opportunity for 2021 for your clients?
Well, look, I would start out by saying that absolute returns in U.S. large cap shares will probably not match 2020 or the year prior. That we have built in a significant recovery and the impact of the dramatic easing in monetary policy. So the one thing that we probably can't double up on is the effects of falling interest rates and the valuation of growth stocks. We still have a long way to go to close the economic impact in cyclical stocks that have been beaten down by COVID. Now that, I think, again, it's come pretty significantly. It's come very, very fast, but there's a lot further to go. Only about 1/3 of that dispersion closed. So when we look forward, we have to say that many of these types of companies are not long-term growth opportunities. They may be under some secular pressure, industries like energy, for example. But there's going to be a rebound in those. They're going to go further, and then we're going to go back to high-quality income growth type equities. I think that we'll still do well with that. And as you said, there's a long way to go. We can grow solidly all the way through 2022.
Greg, this idea that perhaps we are experiencing the beginnings of a catch-up trade in cyclical stocks, value stocks, things outside of large cap growth. One, does it make sense to you that that process is going to remain underway? And then two, is it only going to be by the cheaper laggard stocks going up as opposed to a little bit of pressure on the big mega cap growth stocks?
Yeah, I think it does make sense that we have a lot more runway here. I think that 2021 will look a lot like 2010 to 2012, as your previous guest intimated, where we saw sectors that had not participated grow faster than tech in growth from an earnings perspective off of a cyclical bottom. And so I do think that there are a number of sectors that will benefit from that, projected to grow 2 to 3 times as fast as tech will grow next year, for example. In terms of where we should look, again, there are a number of cyclicals that have been beaten down and neglected in this rally. So some consumer discretionaries, look particularly appealing to me, where we know what their business model looks like next year, such as gaming stocks, which are not like airlines and not like cruise lines, where we don't know what their business model looks like next year, and the CEOs don't know what their business model looks like next year. But we have some actual hard evidence, some regional information on how their businesses have already started to rebound. Names like Wynn and Las Vegas Sands should put up $3 a share in earnings and $3 a share in dividend from a net loss this year. I'd also look at the banks, where we still trade at a significant discount to price to tangible book from their histories, albeit a lot of the gap has been closed, but there's still some great names in there that have traditionally led us in a recovery.
Strengthen as the morning goes on. Stephen, I'm wondering if you're concerned at all about technical forces in the markets going into year end and going into next year in terms of rebalancing and the force that could have given the run in stocks. Will portfolios be forced to rebalance? I mean, JP Morgan had this interesting note out, I think about a month ago or so, saying $300 billion would go from stocks to bonds simply because of rebalancing.
Well, that's a really good opportunity then to invest fundamentally around those types of technical forces. That, again, this is probably the rebalancings will not occur in the final week of the year when liquidity is low. But if dedicated asset managers who do asset allocation and put money back into very, very rich bond markets, and that causes any kind of slowdown in equities, you want to take advantage of that. And you probably won't even be able to tell when it occurs in markets in all likelihood, as the early part of the year when things like this does occur. It's a more liquid period in markets, and I wouldn't worry about that too much.
Shepard Smith here. Thanks for watching CNBC on YouTube.